Getting the dimes for doing the time. It's VA disability. Support for the Milmo Show is provided by Navy Federal Credit Union. Being in debt can take a serious toll on your finances and your mental well-being. Navy Federal Credit Union can help you take control of your debt. They offer financial tools and resources designed to help you get out of debt. They're offering 0% intro APR on credit card balance transfers for 12 months, plus you can earn $250 when you spend $2,500 within the first 90 days on a cash rewards or a cash rewards plus credit card. You can learn more at NavyFederal.org. Hey, welcome to the Milmo Show, where I help the military community make, save, and invest money wisely. I'm your host, Lacey Langford. Getting out of the military can be exciting and daunting times all mixed into one. In addition to starting a new career and potentially moving to a new location, plus shifting your identity away from being a service member, there are things like VA disability compensation, military retirement pay, and tax planning to conquer. In this episode, Curt Sheldon, a former fighter pilot and highly respected financial expert, dives into the essential financial and tax considerations for service members and veterans navigating VA disability compensation and military retirement. Curt explains the key differences between VA disability compensation and military retirement pay, breaking down how programs like concurrent retirement and disability pay and combat-related special compensation work together. Plus, he sheds light on the little talked about Strickland Decision. Curt Sheldon is a certified financial planner, enrolled agent, accredited investment fiduciary designee, and a president of C.L. Sheldon and Company, LLC. He also is the author of Well and Faithfully Discharged Financial TTP for Military Retirement. Curt provides comprehensive financial planning, including integration of military and Veterans Administration benefits, tax planning and preparation, college and retirement plans. He specializes in working with transitioning senior military officers. Here is my chat with Curt. Hey, Curt Sheldon, welcome to the show. I appreciate you being here.
Thanks. Happy to be here.
This is, I will say, you're one of the more nervous I've been for an interview because I feel like all of these topics are very overwhelming for me. So I can't imagine how they are for other people because I do talk about these things. I know these things, but it's like there's a lot of nuances and you want to make sure that you have good intel on this information. So I'm excited to have this conversation. I'm not nervous about you, Curt. I'm nervous about the topic. So first off, I want to start with, before we go into everything out, can you kind of explain the VA disability and military retirement? What are the key financial and tax differences between those two? Because I think that's an important part of all the story you're going to tell.
Okay, so the primary difference between the two from a tax standpoint is VA compensation, disability compensation is income tax free. So it's not taxed by the IRS or by any states because it doesn't show up on your federal tax return. Conversely, a military pension, whether you get it for medical or for longevity, that's going to be taxable income at the federal level for everybody. Some states tax it, some states don't. One thing I'd add, though, is a lot of people, I'll see things on discussion groups, and people say things to the extent of your VA disability never goes on your tax return or never affects your tax returns. But there's one small place where it does, and that has to do with the sales tax deduction. So when you itemize your deductions, you can claim either state income taxes or sales tax as a deduction. A lot of states don't have income tax. So in those states, you would deduct your sales tax. And that comes from a formula. And when you calculate that formula, you can include tax-free income in the formula to calculate the sales tax that you paid. So you can actually increase your deduction for that by including your VA disability compensation in that calculation. So it's not real common, but it can make a difference, of a few $1,000s in sales tax paid and can reduce your taxes by, $100 or $200. So it's not something that's completely off your tax return, but it isn't subject to income tax.
I think that's one, I didn't know that, but I think a lot of times it's a misconception for some people that their military retirement is not included in income tax federally. And so I think that's important, like kind of going into these other questions for people to understand, like, yes, that is on the table. So I want to know if you can break down kind of the playing field of VA disability and military retirement and how they work together. And I wanted you to touch on concurrent retirement and disability pay, CRDP, and combat-related special compensation, CRSC, because I feel like that's less talked about.
Okay. So at the basic level, the way the two interact is if you are receiving military retirement for either medical or longevity, at the basic level, every dollar that you receive in VA reduces your military pension by $1. That's the general rule. Wherever you're in a tax class, people talk about the general rule, and then they talk about the exceptions. And the exception to that is if you're rated 50% more or more disabled by the Veterans Administration. Then you receive what you CRDP, Concurrent Retirement and Disability Pay, and you get your VA disability on top of your full retirement pay. But that only applies for longevity retirement. If you are medically retired, then the general rule applies that any dollar that you receive in VA compensation reduces your military pension by $1. So that's how CRDP interacts. CRSC, combat-related special compensation, is tax-free income that basically replaces a portion of your pension. And it's an election that you make every year. The DFAS and the VA will ask you, do you want to take CRDP if you're eligible, or CRSC? And you need to be a little bit careful. People, as I think I mentioned, CRSC is tax-free, and people will say, tax-free, I want that. That's not necessarily what you want to do, because the CRSC only applies to the percentage of your disability that is combat related. So let's say 50% of your disability is combat related, the other 50% isn't. You would get a smaller amount, and that tax-free amount may be less than the after-tax amount of the CRDP. So you're going to want to do a little bit more analysis than I like tax-free, I'll take that. You're going to want to say, hey, I get X amount of dollars tax-free here. With this decision, I get Y. Taxable, but after tax, it may be more or less than the CRSC amount.
I've gotten this question from military spouses, especially, in the special operations community. It comes to divorce. And so in a divorce, your your military retirement is divisible, depending on how long you've been married and all of those rules that go along with it. Your VA disability cannot be touched. But how does CRSC, the combat-related special compensation, play into that? Because, a rumor started that, a lot of, service members are moving their stuff to CRSC so that it's not divisible in a divorce.
I'll tell you up front, I'm not 100% sure. I can give you an informed speculation, I guess I'd call it. So since the election, it's an annual election, I would suspect that if you can't make the election to take CRSC upon no, you're talking divorce, not death. To be honest, I would say I wouldn't be comfortable. And this is a topic that I feel like is a new thing that's being asked, and I'm not fully educated enough to answer that question. But I'm like, I just feel like I get VA disability, not divisible, but being able to move stuff around to make sure it's not divisible, I think is a concern for some people, especially given divorce rates and things like that. So I was just curious if there was. Give me something to go research.
Okay, well, then this will be continued. We'll have to have this discussion again to kind of follow up on that. But so when you say concurrent, so if you are getting, let's say, 50% disability and you have your military retirement, those are two separate paychecks, correct?
Correct. You'll get two separate deposits. Again, if you're 50% or more, you'll get your full, longevity retirement pay. And then you'll get a second check from the VA on top of that.
But let's say you are 30% and you're retired from the military, because none of this applies if you just separated. So if you have a military retirement, 30% disability, you are getting one check. It's just 30% of it is not taxable or reduced.
I wouldn't say 30%. The benefit that equals your 30% disability is tax-free. And you see it if you look at a retiree account statement, you'll see a VA offset in there that reduces basically your taxable income.
Okay. Now I want to ask you about what is the Strickland decision? Because I feel like a lot of people don't know about this. I think it's little talked about. And so I feel like you know this backwards and forwards. So what is that?
Yeah, this is one of my areas that I really have put a lot of time into. And I first found out about it, I guess, when I got the card from the VA when I retired, and it said you may have rights under the Strickland decision or something like that. Consult your tax professional. And I said, what the heck is this? So I did some research on it. And basically, there was, I think it was Major Strickland in the Vietnam era, was rated less than 50%. Well, at that time, there was no CRDP. So it was dollar for dollar, no matter what your percentage was. And when he filed his tax return, he reduced his military pension by the amount of VA benefits that he should have received while his claim was being processed. So, and when I retired, my claim took 14 months. So if you're less than 50%, you may have 14 months where the government is saying, or DFAS is saying, you're getting taxable pay, but in reality, it should have been reduced because your claim dates back to 1 month after your retirement. So he got audited, and I want to say it was less than about a $600 tax bill, but he didn't want to pay it. And he took the IRS to court, and he won. And the IRS concurred, which they don't always do. And they wrote an Internal Revenue Ruling, IRR 78-161. And I only bring that up because when you do your taxes, you kind of want to know that. And basically what it says is if you have a time period where from the time your VA benefits should have begun until you actually start receiving them, and there was VA offset taken, you have the right to reduce that amount or deduct that amount from the amount reported on your 1099-R, which is what you get instead of a W-2 when you're retired. So in essence, let's say you retire on the 1st of December and it takes the VA, so your benefits start accruing on the 1st of January, you start getting pay on the 1st of February, and the VA doesn't figure it out till August. So you've got basically 6 months of, say, $100 a month. You'll get your 1099-R will not show that reduction. You'll get that full amount will still be reported as taxable. So what you do is you report that on your tax return as taxable income, but then you make an adjustment and you reference that IRR 78-161 and you deduct the amount of VA offset that should have been taken while your claim was being processed. Once your claim is processed and they start taking that VA offset, it no longer applies because it's reported accurately on your 1099-R. It shows just the taxable amount. If it spans 2 years, you can file an amended return to get that money back. And people may look at it and go, well, it's $600, who cares? But, well, first of all, maybe significantly more than that. But oftentimes when you start taking money off the top like that, you start increasing other things. Credits or deductions become eligible because your adjusted gross income goes down. So it can amount to more than 20% of $600 or whatever the case may be. But you have the right to do that. And the IRS agrees with it, but you need to annotate it on the tax return as I think it's an other deduction for adjusted gross income, and then you just write in IRR 78-161. What it does, well, first of all, and again, that in current day, that only applies if you're less than 50% disabled, because if you're 50% or more, like we just talked about, there is no VA offset. You get your full pension and the full VA benefit. What it doesn't mean, and this is one of my things one of my crusades, I guess, is it doesn't mean that if you're 100% disabled, 100% of your military pension is tax-free. There's an email floating around out there, and it references an IRS pub, and it's page 17 or something like that. I've been against that for years, but I've never had anything that I could hang my hat on. In 2022, there was a court case, Valentine versus the commissioner, where a retired Army soldier, I don't remember rank but claimed that I'm 90% disabled, 90% of my VA disability, 90% of my military pension is tax-free. Got audited. She went to court, claimed that referencing this pub, I can do this. The court ruled against her, literally said, or very close to literally said in their opinion that it was a gross misconstruction of the IRS publications, and she lost. The rumor's still out there. It seems to be dying off, but I think the IRS also knows that the rumor is out there. I am aware of an individual that got audited and is looking at tens of thousands, if not pushing $100,000 in possible back taxes because high disability, relatively high retirement pay, and claimed it all as tax-free, and the IRS said, we don't think so. And now they've got the court case on their side as well. So if you hear that rumor, it's not true. The email, in general, I say don't take tax advice from random emails.
Yes, please don't.
But the Strickland decision does not apply to that, and that's not an application of the Strickland decision.
Yeah, but to be clear, because I feel like people just get so confused sometimes that VA disability, not taxable, we're talking about them trying to claim their military retirement under the Strickland decision, which is...
Right. The only time that applies, again, the only time the Strickland applies is if there's a delay in you receiving benefits or your benefits being awarded, and you're less than 50%. And then it's only the amount of VA offset that should have been taken. It has no relationship to your actual pension amount. If you're 30% disabled, you're going to get X number of dollars, and that's how much you should reduce your pension by for those X number of months that you're waiting for the VA to determine your claim.
And just an example, so let's say you got out a long time ago and you were 30% disabled. So you have the offset, and what if you refiled under what's the new act that you recently filed and got more? So now you're over 50%. Under the Strickland decision, if it took 14 months for that to be decided, you went from 30 to 80. You can get it in that 14 months, or does it go all the way back to when you first filed? Just curious if you know that.
When you first filed, if there was X number of months that you waited, those months, you would have the offset. If you now go to 80% and it's retroactive to your retirement date, and you did take the option under the IRR 78161, I would say you would most likely owe additional taxes because that offset that you took there wouldn't have been an offset because you're more than 50%.
Oh, okay.
Now, with that said, there's basically a 3-year statute of limitations on a properly filed tax return. So if you're talking 5, 6, 7, 8 years ago, you're past the statute of limitations.
Okay, but that 14 months, you still would be able to take it though, even though you had already had benefits.
Yeah, if your disability goes up, it's likely that and it's retroactive to your retirement date, then it's likely that if you took advantage of the Strickland decision and then you increase above 50%, you actually paid less in tax than you should have. If it's again retroactive back to retirement. So if we just take it in two steps, if you're 80% disabled from retirement, you would never have a VA offset.
Right. If
you're initially rated 30% and you claim a VA offset on your taxes, and then they retroactively take you to 80%. You wouldn't have earned that offset because everything would have been you would have received CDRP on top of the retirement.
Yeah, but if you never had claimed
if you never claimed it, it wouldn't matter.
Okay. What do you wish? Are there any other misconceptions about it besides that military retirement, or anything that you think more people should know about the Strickland decision? Because I feel like it's not talked about a lot.
Yeah, the one thing I would say. It's not Strickland pure, but it has to do with bureaucracies being slow at times. As I just mentioned, there's a 3-year statute. It's possible that the statute could get run out while the VA is trying to figure out your claim. I will say it's much better than when I retired, but when I retired, it took a long time to get claims. There is this concept of called a claim. I want to say claim a right, but that's not it. But you can file a claim against the government, basically say, due to governmental action, I think my tax return may change, and you can extend the statute of limitations beyond that 3-year threshold and get some extra time. And you basically file an amended return and say, hey, this is being adjudicated. The government's being slow. I think I may have a claim, and that keeps your tax return open, if you will.
What if people know they qualify for the Strickland decision? Is this something they need to seek out a tax professional? And are there a lot of tax professionals that know about this? That would be the thing I would be concerned about.
It's not inherently complicated, but it would be from a practical standpoint, and we don't use in our company, we don't use TurboTax or how you would make TurboTax show. It might be the hardest thing to do. There are a handful out there that work with it. It might be one of those where, hey, for this year, I'm gonna hire somebody to do it because it's out of the ordinary and I can't figure out how to make TurboTax put in IR 78161 and do the subtraction. It's probably, obviously I have my biases, but I would say that might be one where you want to get some help with, and especially if you have to amend.
Yes, I have used TurboTax, and I could think, like, how would you ever find that? Because you're just following the prompts, and I've never seen a prompt about the Strickland decision. So, okay, how can veterans calculate the financial impact of their VA disability rating on their retirement benefits? So I feel like you're getting out, like you're trying to figure out what your financial life will look like. If that's not a done deal, do you have any advice for people, like, because you don't want to, count on all of that extra money and then not get the disability you think you're going to get. And I feel like some people are spending that paycheck before they've ever received it.
Yeah, I can tell you what we do in practice from the financial planning side of my company is we don't count on it till it's awarded. That's bird in the hand. We're worth two in the bush. So we don't recommend that you count on it because it could go anyway. It could take months, and it's just so. I would not count on it. The one thing I will say, if you're, trying to do budgeting and compare it with what you're making in the military, obviously you want to gross it up for the fact that it's not taxed. So if you're in a 22% bracket, you would want to divide the VA by, say, it would be by 78.78, and that would tell you how much taxable income that's equivalent to. But I still wouldn't plan on that. That's money I'm going to spend, or I'm going to buy a new car because I know I'm going to get this. I would wait till the money comes in before I buy a new car.
Yeah. Yes, I completely agree. No sense, because that's never know. Like, things could change. I feel like a lot of people get advice based off of another person's personal situation, and the conditions don't apply to them, and so they've made plans that, I'm going to get this too, or if anything, just the hope that you're going to get it. And then that, is kind of when you're going through all this transition, not to mention your financials changing. A lot of things that were on active duty that weren't taxed are now taxable when you get out. And I feel like the tax hit for a lot of people is, just soul crushing for a lot of people. And if you're planning on disability and all that stuff and then get extra taxes, it's hard for people.
I agree.
Yeah. What are tax considerations service members should be aware of as they're transitioning out of the military? So just touched on it. Like, what are those things that people should have a heads up on? So
the two biggest things we see, the first one is withholding. And I'll hear a lot of people say that your tax bracket goes up. And that's not really the way the root of the problem. The root of the problem is the tax code, and I always use this reference, and I don't know that anybody gets it, but the tax code was built for Ozzie and Harriet, which, for those who don't know, was a show a long time ago where there was one husband, one wife, and the husband went to work and the wife stayed home. And there was one source of income. And our tax tables are designed for that. It's designed for one source of income. So when you retire from the military, you have two sources, and assuming you get a job, you have two sources of income. And the DFAS is going to look at it and say, okay, you're married and you're getting X amount. We're going to subtract $30,000 for your standard deduction, and that puts you in the 10% bracket. So we're going to withhold at 10%. And your employer is going to look at your pay and they're going to say, we're going to subtract $30,000 for the standard deduction, and that puts you in the 12% bracket. So you get a combined withholding of 11%, assuming they're equal. But when you put the job pay on top of the military pension, now they start counting at 12% and it tops out at 22%. And you've only withheld 11%. So very common to see people having to write a check for $5,000, $6,000, $7,000 when they file that first tax return. The first year they're fully retired. We'll see and we say, yep, this is what happened. They looked at it like this, but the IRS looks at it like this. It's not really anyone's fault. Everybody's withholding correctly. It's just when you start combining income sources, it doesn't. The tax tables don't work. And if you add a third source of income, say you have a spouse that works as well, it just gets worse. And the more income sources, the more problems you have. So what we recommend that people do for that is properly fill out the W-4. Most people, I think, say, well, Married with Four has worked fine for the last 20 years. It'll keep working fine. No, it probably won't. So the W-4 has its issues. I mean, as part of the Tax Cuts and Jobs Act, they simplified it, and the instructions went from 4 pages to 7 pages. So there's that. The form itself is kind of challenging, but the IRS does have a relatively good W-4 calculator that you can go in and plug your numbers, and they'll tell you what to put on your W-4s. What we do, and I think the best option, is to sit down and do a 1040 ES, which the ES stands for estimated, and you basically do your tax return on your projected numbers, and you say, holy cats, I'm going to owe $6,000. Then we recommend that you go into DFAS, just because I know how it works, and you go in and there's a place where you can say, take an extra $600 a month. And now you're covered for the year. Now, if you figure it out in June, you may have to do $1,200 a month for 6 months, and then at the beginning of the next year, you can do $600 a month. I think that's the most accurate way to do it. But most retirees, if they're working, probably going to see a 15% average tax rate. So that's kind of another check you can look at and say, okay, my retirement pay is $5,000. 15% of that is $750 for, I think, no. 500.
Off the top of my head.
So I think it's $750. But you want to make sure you're getting at least the 15%. That should, as a, hey, I don't want to mess with the W-4 calculator. I don't want to mess with this 1040 ES. Well, you better at least check and make sure you're hitting an average tax rate of about 15%. The other big thing we see is Roth IRAs. You're on active duty, you've got a Roth IRA, the money's going in automatically, you don't even think about it. And what a lot of people don't realize is that there is an income limit on the ability to contribute to a Roth IRA. And I don't know the 2025 numbers right yet, but 2024 it starts at 240, and I think it's phased out at 250. And a lot of people, especially here where we are right now around Washington D.C., they'll hit that, and then they have a problem. And if they don't fix the problem, they are going to owe the IRS more money. There's a 6% excise tax on those excess contributions for every year that they stay in the account. So it's a 6% per year. You can get out of it if you remove the contribution and the earnings on them by the time you file your tax return, plus extensions. So you basically have till October 15th of the next year. You can avoid the penalty. You'll pay taxes on the earnings unless you recharacterize into a traditional IRA, but you won't have to pay the penalty. After the first year, I always find this is a bit of a trade-off, I guess. After that first year, you would get hit with the 6% penalty, but then if you take it out the next year, you only have to take out the contribution. You don't have to take out the earnings. So, excuse me, I prefer not to pay penalties. Yeah. So I recommend to people to take it out. But if you wanted to say, well, I'm going to make 10% and it's a 6% penalty, I'll take that trade-off. You could maybe make that argument, but we tend to let's just get this cleaned up, because if you really want to get money into Roth, and this is sometimes the idiocy of the tax code, you can recharacterize the contributions plus the earnings into a traditional IRA. Then literally the next day you could convert them back to the Roth, and you would only pay taxes on the earnings. So there is an income limit to contribute to a Roth IRA. There is not an income limit to convert from a traditional IRA to a Roth IRA. So then some people call that the backdoor Roth. You make a non-deductible contribution to a traditional IRA, and then you convert it to a Roth. And that's in essence what you're doing there.
What are some financial considerations that are important for people that are medically retired? I know you touched on some of them earlier, but just speaking of them specifically, because I feel like often that sneaks up on people. They didn't know they were going to get medically retired, and then it happens. Some people do have more of a heads up that they know it's coming in the pipeline, but are there any financial things that they should prepare for, or tax-wise?
So I think this applies with any retirement, but probably one of the best things you can do for yourself is to have a war chest in cash when you make the transition, because it gives you time and it gives you options. That may or may not be possible, but I would say as soon as you find out you're going to a med board or MEB, I would even consider stopping contributions to things like thrift savings plans and IRAs and build up some cash if you don't already have it. build up, 6 months, 7 months, 8 months worth of living expenses, so that when you are out and the income, drops at a minimum, you're not saying, I have to get a job tomorrow or I can't make the rent. And you can say, okay, I can breathe, I have some space, I can be selective in my job search. Of course, that's assuming that employment is an option, which I know for not everyone medically retired that's the case, but assuming that. Beyond that, from a tax standpoint, I would be concerned, the offset, again, as mentioned, if you're getting VA disability that reduces your military pension, that may set up, again, if it takes a while for things to get ironed out between DFAS and the VA, there could be some potential there for a Strickland-like situation to be in place. Although, from my understanding, generally the VA and the military retirement are pretty well squared away by the time you are actually separated. Beyond that, it may present some opportunities. Again, if you're in a situation where your income has dropped significantly and you were making pre-tax contributions to, say, an IRA or TSP, now might be the time to convert when you have a low, do some conversions, fill up lower tax brackets. If this is more of a long-term play, I'm going to pay, since I'm in the 12% tax bracket now, I'm pretty sure by the time I start working and even when I get to my ultimate retirement, I'm going to be in above a 12% bracket. Let's fill up that 12% bracket with Roth conversions now, and then have future tax-free growth. So that may be an opportunity that one wouldn't necessarily, opportunities don't usually come in the same sentence as medical retirement. That would be one that might be available. Beyond that, I don't know that there's a whole lot of difference between, you're going to have obviously reduced. The other thing, though, perhaps worth considering, while VA disability and military disability are not the same as Social Security disability, it's probably worth an application. The Social Security is very strict. The most, 100% P&T isn't an automatic guarantee that Social Security you're going to get Social Security disability. But if you're being medically retired, it's certainly worth a shot to see what Social Security Administration says.
That's a good point. But yeah, I know that it scares people a lot away because it is difficult to get, but you're right. You don't know what will happen, and that's the time to give it a shot. I want to talk about VA disability compensation and retirement pay in relation to estate planning and survivor benefits. Like, how does that all work? I feel like some, again, misconceptions about your disability if the service member passes away versus your retirement pay if the service member passes away.
Okay. So let's start with we'll go with the general case.
Yeah.
So the general case is when you check off the planet, your military pension stops. And pretty much the same thing with VA disability. Now let's go to the exceptions. If you elect to take the survivor's benefit plan, then you can, your pension, a reduced amount of your pension will continue being paid to your spouse. What that amount is determines on what you select as the base amount. And I should point out, I use the word you select. It's not the service member's selection, it's the spouse's selection. Only a spouse can elect less than full SBP coverage. And I've heard a couple conspiracy theories on that, or people grousing about how the military, I can tell you those are the exact same rules that civilian pensions have, the few that still exist. Yeah. Only a spouse can elect out of full survivor coverage. So you select an amount between your 100% of your retirement pay as the base amount down to $300 a month. And then your spouse will receive 55% of that amount that you receive of the base amount. So just to keep the numbers simple, if and I know this number is high, but if your military retirement is $10,000 and you select that as your base amount, the spouse will receive $5,500 per month. The price you pay for that, and I don't even like to use the word pay, I like to say you reduce your pension by 6.5% of that base amount. So again, if we use the $10,000 example, it would be $650 a month that you would receive in less pension. But as we establish, your pension is taxable income. If you reduce your pension by $650 and you're in, let's say, the 20% tax bracket, again, just to keep the numbers simple, you will reduce your tax bill by $130. So that $650 really only costs you $520 because you would have paid $120 in taxes on it anyways. So it does actually, you pay less than the sticker price because of the tax benefits. And if there's state taxes, there may be even another 5% on top of that. So we might be talking 25 or 30% reduction in the premium that you pay for the SBP because of the tax benefit that comes with it. And that can make a lot of differences in your taxes in other places because it reduces your adjusted gross income. So it's important to look at the full picture there. A lot of people will just say, well, I'm paying $650 and I can get an insurance policy for $450. Therefore, the $450 is better than $650, and I'm going to take the $450. Well, before you do that, make sure you at least account for the tax savings that you have. The other thing to keep in mind is it's 55% of the base amount. So it's not 55% of what you receive after you select SBP. So again, using our example of $10,000, if you take the $650 out, you're down to $9,350 is what you're actually getting in retirement pay before tax. But your spouse is going to get $5,500. So it's not 55% of what your take home is. It turns out to be more like 59% of what your take home is because of the fact that it's on the base amount, not the base amount reduced by the premium, if you will. So it's a higher percentage than I think a lot of people think they're or a higher dollar amount than what people think they're going to get if they just look at here's what I'm getting in retirement pay. So that's the basics on the military pension. Again, it only continues if you select SBP, and I should say you can also select beneficiaries other than the spouse. If it can be children only, it can be other relatives. The premiums for those are calculated differently than the straight 55% or 6.5% of the base amount. Depends on the age of the beneficiary and your age in some cases as well. But if there is a spouse involved, again, only the spouse can opt out of full coverage for herself or himself. On the VA disability side, it becomes a little bit more complex. There is dependency and indemnity compensation that can be awarded to a surviving spouse if the circumstances are correct. Generally speaking, the very general rule to that exception is if the death is related to the disability, the service-connected disability, it will continue. If someone is 100% P&T and it was awarded at the time of retirement or separation, and you survive 5 years, the spouse, regardless of the cause, the spouse will receive DIC. If it's not awarded at the time of separation, then you have to survive 10 years in the house, again, at 100% P&T, regardless of cause. So you could get hit by a car, have nothing to do with your VA disability, but if you meet those two thresholds, the surviving spouse would still receive the dependent and indemnity compensation. Similar to VA benefits, it's not based on rank, or it's just a set amount for the spouse, and I think it's right around $1,500 a month right now. Not 100% sure on that, but it could be significantly less than the SBP amount. Good news, up until about, time always goes by too fast to me, I'll say maybe 5 years ago, there used to be a DIC offset, much like there's the VA offset, where the SBP payment would be offset by the DIC amount received. That has gone away. It's phased out within the last, I want to say 2022 or 2023 might have been the last year of the phase out. So now you can receive both, which is much better for the surviving spouse.
For service members that are getting ready to retire or separate, what's something that you wish more people knew or maybe prepared for?
And again, the taxes, I think, is a big, and I am a tax guy, but I think the taxes are a big part about it. I think the war chest that I mentioned is important. Again, it just gives you flexibility and the ability to be selective in your job hunting process, again, assuming you're going to job hunt. Understanding civilian retirement plans. I think, it's not too hard to figure out the military retirement plan. It was a little bit different for me, but now it's basically number of years times high 3 times either 2% or 2.5%, depending on whether you're BRS. And that's about what we know about retirement plans. And now you start going out in the world and what's a 401k and what's matching and what's the limit. I've had more than one person tell me I'm maxing out my 401k, and I'll look at it and I say, well, you only put in $10,000. And they said, yeah, that gets me the maximum match. Well, no, that's not maxing out. That's maxing out your 401k is hitting the regulatory limit, which for this year going into 2025 is $23,500. And then if you're 50 or older, I think you get another $7,500. Again, the 2025 numbers are not fully burned in yet, but I see a lot of people that really don't get it, and then they'll confuse the point that with matching, they'll think that counts against their deferral limit. So I can only put in 20,000 because my employer's putting in 10. No, it's a different limit for what can go in for that. You can still put in your full 23.5 or whatever the limit is for that particular year, and your employer's contribution counts against another limit, which is much higher. It's up around $70,000. So people they limit themselves because they think that the employer counts against what they can do. And then there's some real, especially if you're in the cyber arena, there's some real cosmic and complicated, what we call non-qualified retirement plans, things like incentive stock options, deferred compensation that can be, if you're in that realm, you're going to have to be making some pretty complicated decisions pretty shortly after a job offering. So that occasionally, and this is more, I guess, maybe in the errors, but if you know about it, you wouldn't make it. Occasionally, we'll see on tax returns that we'll see an HSA contribution for a military retiree. And that's kind of a no-no to HSA, health savings account. They're great. You get to put in pre-tax dollars and use it to pay for medical expenses and never pay taxes on the contributions. But you have to have what's called a high deductible health plan to have the right to contribute to an HSA. And since you're covered by TRICARE in retirement, you can't have that. If you have TRICARE, you can't contribute to an HSA. So one or two a year, we'll see a tax return with that. So just keep in mind, benefits. Due to the fact that I'm a military retiree and I have health care coverage and some of these other benefits, can I do this? And you can't necessarily rely on the HR person at work because they don't know you're covered by TRICARE. They're going to say, well, yeah, you've got this HDHP here at Joe's company, and you can contribute. No, you can't.
But you're not in that health plan. It's just available to you.
So, you have the TRICARE coverage. And it's certainly not worth giving up TRICARE coverage to be able to contribute to an HSA. So other things to be aware of. Again, the tax shock is a big one. And I would say understanding your benefits, probably those are the two big things.
Those are really great tips, especially the HSA, because, that is a great thing to sign up for, but you don't qualify for it. And that's going to be a nightmare for you later because you're going to be paying that back. Yep. So, okay. Well, I want to switch gears and now ask you a couple of quick random questions I ask everybody. Okay. First off, what is one resource or tool that you use that makes your life easier or your work?
So, and this is probably a bit too concentrated, but for other people that are in the profession, I use a tax research service called Parker Tax. It's relatively inexpensive. It doesn't have the best search engine, but it's got great answers. I mean, that's where I first started learning about the Strickland Decision, and it's actually addressed in there. And it one of the few places. It's probably more for a practitioner than for a layman, but I find that to be very useful. And then for those who, maybe I'll throw a second one at you. For those who are in business, one of the things that we always struggle with from the tax side is automobile deduction because they don't have records. And I use an app, used to come in here today. It's called TripLog. It's GPS enabled. You get in, you hit start, you get to your destination, you hit stop. It's got the mileage. You hit save. You don't even have to hit save. At the end of the year, you download a spreadsheet, and you've got all your mileage for the year. There's different ways you can use it. That helps a lot for trade. I can't imagine having to do that in a written log, which people did not too long ago. But substantiating business miles on an automobile is a challenge for a lot of business owners. So if you're thinking about starting a business or you've started one and you do use a vehicle for your business, that's a really good way to track it.
Yes, no, that's a really great one. Well, I'll be sure to link all of that for everybody. All right, now what is your favorite book right now or your favorite book of all time?
I'm going to give you two. Okay, so my favorite military-related book is Killer Angels, which is the story of Gettysburg. It's a novel, but it's pretty historically, it's in good historical context. And I just like the insights or the ability to think in the minds of the officers who were there and who were fighting that. This is an oldie but a goodie, but I still find it to be a very, it was How to Swim with Sharks Without Getting Eaten Alive. And it's a business book. It's written by a guy, I want to say Jim McKay, but he's from Minnesota and he ran an envelope company, which is about the most nondescript product you can imagine. Who will I get my number 11 envelopes from? Yeah. Gee. And he just talks about how he ran his business and how he turned it into something. And he has this like 60 question questionnaire of all the data that they obtained about their clients, so that at the click of they didn't even have a mouse. Click of a mouse, they could know everything about this client. It's just a good business book about how to run a business and be successful.
I like that. I've never heard of that one. I'm definitely going to be checking that one out myself.
Hopefully it's still in print. You might have to go to an antique bookstore.
Well, I have found too that now like some older books just Google has for free. Right. Like you could just go read a book online for free. So I'm also a big proponent of, we have a really great used bookstore right outside of Greensboro where I live, and I keep a list in my phone so when I do get a chance to go there that I can get used books right there in person. So, well, those are all really great. Okay, now it's time for my favorite part of the podcast, which is game time. And in honor of your visit today and being in person, we're going to play rock, paper, scissors. Okay. So just if you get 2 out of 3, best 2 out of 3, you get bragging rights that you won game time on the Milmo Show. And as a reminder, let's see, it's rock, paper, scissors. Okay, so we'll do 1, 2, 3, shoot. Okay. So that's the rhythm, the battle rhythm. 1, 2, 3, shoot. And then we'll see if you get 2.
That's pretty quick. I hope I can keep up. Okay.
So I don't know if I can replicate that again. Okay, here we go. 1, 2, 3, shoot. Oh. Okay. 1, 2, 3, shoot. Ooh.
I don't think I'm going to get 2 out of 3.
Yeah. 1, 2, 3, shoot. Okay, you got me on that one. Yeah. I thought you were going to do rock, and I was going to. So I get bragging rights that I won rock, paper, scissors, and I've been very rusty. So.
Although I think the rest were on your side.
Yes, I do think they were on my side. So, well, I really appreciate you coming and chatting with me. Can you tell everybody listening where they can learn more about you and your work?
Sure. So our company's website is clsheldon.com. I have published a book. It's available on Amazon. The name of the book is Well and Faithfully Discharged, Financial TTP for Military Retirement. So that's available. I'm active on LinkedIn. I have a presence on, so you can just search my name there, Curt Sheldon. I do have a Twitter presence, but I'm not real active and a minor presence. The other thing, if you go to our website, we do a monthly newsletter. That's all we send is once a month. We don't pepper you every week. And if you'd like, you can sign up for that there as well. And I talk about financial stuff in the newsletter every month.
No, that's great. I'll be sure to link to all of that. And just a plug, you have really great articles on LinkedIn. Part of having this conversation, I really enjoy those. So yeah, people check it out. So.
All right. Thank you.
Thank you, Curt. Thanks to Curt for coming on the show to talk about VA disability and military retirement. Also, thank you to Navy Federal for providing support to the Milmo Show. You can head over to milmo.co to get all of the links and the resources from this episode. And while you're there, be sure to sign up for the Milmo Memo newsletter to get all of my updates. I appreciate you listening, and I'll talk to you next week.